Let's keep talking about these markets and what we learned from the Fed yesterday and why it's impacting today. And to do that, we're going to introduce into the stream Steve Sosnick. He's been here several times before, Interactive Brokers Chief Strategist. Good to have you, Steve. There's so much to talk about. And in several notes, especially one you just sent to your clients, you talked about the dot plot. In English, the projection that the members of the FOMC have going forward with inflation. It drives so much of what we see in the bond market, but you point out that perhaps people are overreacting because there's going to be no interest rate increase for what, 2 years?
Yeah, well, first of all, thanks for having me again, Adam. Yeah, right. The dot plot right now is extraordinarily conservative or static, I guess is probably the better word. We saw a little movement up. A couple of FOMC members raised their anticipation for maybe 2022 interest rate rises, and that's got that basically fits in with the theme of the Fed being on hold, more or less until they see the whites of inflation's eyes. But the problem now is the bond market doesn't like that because in his speech yesterday, Chairman Powell was basically pretty adamant, as he had been in front of Congress as well, that he was not really inclined to do anything peremptory about inflation, but react to it if inflation becomes a problem and if we're at full employment. We're a long way off from that. But the bond market now is getting nervous that we could see the inflation becoming a problem before the Fed does anything about it. And that's the little bit of a freak out that we're seeing, that we had been seeing in bonds and that continued today.
Yeah, Steve, it certainly is, especially in a day when we have the NASDAQ off just around 2.5%. We're seeing some of the selling accelerate into the close. I think investors are trying to figure out what to do, how much more selling action we could see in some of these growth-focused names. What is your perspective on that right now?
Well, Shauna, my perspective is if you're there, how much more could you see? A lot. I mean, looking at the performance of the NASDAQ and, seeing the heat map that Jared just showed with red more or less everywhere, there's a lot of valuation that one can worry about. We're very high historically on many measures. And that's, I think, why, even though there's no specifically explicit relationship between the 10-year yield and the NASDAQ, people didn't really seem to mind that valuations were going up and up and up throughout much of the past 12 months. And largely that was because there was the money flowing in, there was the steady earnings, et cetera, et cetera. And if you could divide steady earnings and steady cash flow essentially by zero, you can put an almost infinite valuation on those future flows. Well, the problem is if you start to discount those by ever higher numbers, even though they're still low by historical standards, that doesn't give you much room if you're priced to perfection. It also means that in the markets that have really outstripped their longer term trends or their longer term moving averages, there's some room to go on the downside if the psychology remains as it is.
Steve, help us average investors understand the fact that he brushed aside the question, Jay Powell, on the supplemental leverage ratio for the banks, but at the same time, the Fed was increasing the amount of money that money markets can park in the overnight repo to $80 billion. In a simple to understand, what does that really mean for us? What does that mean for us?
What it means is, and this is a very technical issue, and I alluded to it. And if you want to go to Traders Insight News, which you can see behind me, I explained it at length in my notes yesterday and today. Basically, the banks had always had to have this, large banks, 250 billion and up primarily, had to carry supplemental leverage ratios, which meant sort of extra reserves against deposits but against mostly leveraged assets on their books. The Fed, in the midst of the panic a year ago, pretty much waived that. And they said it was, they did it on April 1st, and that waiver is set to expire on March 31st. As you said, Powell explicitly blew off the question yesterday during the press conference, but we saw them raise the repo rates that they can do. And that basically would be what banks would use if they were forced to then find alternative ways to manage their balance sheets in the way that's required. I think that's partially what contributed to the freak out in the bond market, because the waiver of SLR disappearing means that banks won't be able to necessarily hold as much in treasuries. It'll put some pressure on them. And that's not enough. That's yet one more thing that piled on the treasury market, which is why I think you saw some short covering yesterday and the yields improve a little bit and then, act terribly today.
Well, yeah, well, we're seeing the 10-year yield is up at about 1.75%. Steve Sosnick, it's always good to have you here to help us understand what's really happening there in the bond market. Steve Sosnick is Interactive Brokers Chief Strategist. Good to see you. Look forward to your next joining us.